Hey, this is Jim Francis, and welcome to the 11 Commandments of Financial Success. My pleasure to welcome you to this training. I'm going to talk about 11 key strategies that can help you get on the path to wealth and prosperity. And this is really a function of a friend of mine saying, hey, if you were just getting started out, what would be the important things to get started? And it became 11 rules for success. So here they are. Number one, you need to make sure that you have a financial blueprint for life and for retirement. And what I mean by that is you need to kind of plan what's going to happen. Doesn't matter where you are starting right now in your life, whether you're 20 years old and just beginning, or you're 30 or 40 and you've been working for 10 or 20 years, and you're thinking about, geez, retirement is 55 or 60, or you're in your 50s and you still haven't quite made it and you need a plan for the next 10, 15, 20 years. You really need to start thinking about what's going to make me successful. What is going to be the nest egg I leave or retire with? And it's better obviously to start that earlier than later, because in later life you've got to put more money away at a different interest rate or rate of return, to get the same kind of results. So start early, start often. You start thinking about that retirement program, and I'll actually talk a little bit about different retirement programs and percentages in just a few minutes. But if I was getting started, you can have a rich future no matter where you start. You can have a rich future if you have $25,000 a year, or if you're making $50,000 or $100,000 a year. And let me just kind of give you an example of that. Let's say you're just getting started. You just came out of college, university, or maybe you went to high school and started working, and you're making $24,000 a year. Well, one of the things you can do is to use what's called the 10% solution. And the 10% solution basically means whatever I get in my gross income, per year, per month, per week, however it's done, I'm going to take 10% of that and put that away for my future. Now, when I say put it away for your future, I'm talking about putting it into some investment vehicle, some sort of program. And notice I didn't say savings program. I said some sort of investment vehicle. Talk about that a little bit later on. Well, let's say that I decide that I'm 25 years old. I've got $24,000 coming in every year. I'm going to put away $2,400 every single year for 25 years. Now, if I do that and I have about a 10% rate of return, and some people will say it's hard to get 10%. I'm going to tell you it's actually pretty easy to get 10%. You just don't know where to go to do it. And you've been kind of conditioned by everybody, that 6% or 5% or 7% or 2% if you go into a bank, or less than 2% nowadays, is okay. But let's say we get 10%, on an annual basis, just based on that $2,400 a month, $2,400 a year, put away for 25 years. I'm going to have a $250,000. So not a great retirement, and you think about that, if I'm 25 and I work for 25 years, at 50 I got a $250,000. That's a lot of money compared to what most people have. In fact, I heard a statistic this morning that the average 401k has about 18,000, and people who are retiring have on average about 75,000. Man, that's about 1 year of life and they're done. Let's say that you went to college, you went to university, you got an advanced degree, maybe in computer sciences or IT, or a doctor, lawyer, whatever it might be, and you come out of college and you get that 50 grand a year job. Still putting it away for 25 years, at 10%, you're going to end up with just shy of 550,000 or 540,000 as kind of your nest egg, 25 years when you're 50 years old. And you may be able to retire on that. You certainly will have a better life than, if you retired on the $250,000. But I just want to show you, and I'll come back to this a little bit later on, that compounding, that using compounding over time can have a dramatic difference in your life. So I'm going to keep the same amount of money, the $24,000 a year and the $50,000 a year. I'm gonna say that we put money away for that 25 years, but we're going to just change the interest rate slightly. Rather than getting 10%, we're going to get 20%. And if you're putting that $2,400 away every single year for 25 years, and you run some numbers on it, you're going to have $1.3 million. So the effect of the compounding and the interest rate can have a major effect in terms of the net result. So there is a lesson there, and the lesson there is we always want to get higher rates of return. Now you'll hear people say if we get a higher rate of return, you get more risk. That's not necessarily true. If you have the right knowledge, if you have the right system, you can get outrageous rates of return much better than 20%. In fact, some cases, 10% a month. Past performance doesn't equal future performance. Investment does have risks. You have to know what you're doing before you do it. But if you're trading the stock market or you're buying real estate with limited money down or creative financing, you can make outrageous returns. In fact, sometimes even infinite returns. But I'm just trying to prove right now that time, the compounding, and the rate of return is the most important element of that equation. I can take the same 5,000 a year, if I make that 50 grand, put it away for 25 years, at a 20% interest rate, it's 3 million, right? So obviously, the effect of the compounding over time can have a pretty dramatic effect. And one of the things you want to kind of do is to plan for when that day is, whether it's, at 50 early retirement or 65 or wherever you are, you want to run some numbers. So, I used MoneyChimp to run those numbers. A free service, a free website. You can go there and calculate, what you have right now and what you need to put away for the future. But start planning for it. Start planning for some of the things that you want too, whether it's the boat, the vacations. Start kind of scheduling out what some of those dreams and goals are. So start to plan your work and work your plan. And that certainly means, you need to make your plan in terms of, what your end goal is in terms of money or whatever it might be. And you'd be surprised. Sometimes when you get there, you need to go again and for longer. So, I've had some great dreams in my life and lived some great dreams. Certainly my family was one of my great dreams. They're incredible, but I got the time to spend time with them because I wasn't always working. And, I decided a long time ago that I wasn't going to really work the 40-40-40 plan. I wanted to work, the 7-7-7 plan. 7 major strategies to earn a 7-figure income, over the course of my lifetime, in less than 7 years. And it's possible if you start to work in terms of strategies. The second thing that I want to point out is kind of a blueprint or a key to success is listening to the wrong financial advice. In our culture, financial advisors, mutual fund managers, people that are on CNBC, see people who are giving us advice about putting our money into mutual funds or long-term buy and hold strategies. Quite often they're paid with commissions. And usually there's nothing wrong with the individual. What I mean by that is they're good financial advisors and bad financial advisors. But if they're giving you the wrong system, the wrong advice, that's a bad thing. And I used to believe in mutual funds a while ago. In fact, I've had all of my licenses. I was a supervising principal, and I did that to kind of learn about the stock market, learn about investing. And what I found out was, those tests are not about investing. Those tests are not about, whether there's a moving average change or a MACD or when to buy a stock or when to sell a stock. They're really about protection of the individual and the brokerage firm, and telling people that buy and hold is the way to go and to put their stuff into mutual funds. And I really believe in my heart and soul that that's the wrong advice nowadays. A 401k doesn't work. If it did work, we'd have substantially more millionaires retiring nowadays now that we've got baby boomers than we actually do. And as I said, I heard a statistic recently, that about 75,000 is the average 401k for somebody, in their later years kind of retiring, which is disgusting as far as I'm concerned. In fact, I heard many people talk about a 401k going to a 301k, going to a 201k, to go into a 0k, and the more I learned about trading, the more I learned about investing, the more disgusted I got with some of the financial advice that's going out there. Most of the people say buy and hold, and long term it's going to work for you. And you hear this statistic all the time, the stock market hasn't lost money in 100 years. Well, here's the stock market over the last 100 years, and you're right, it really hasn't lost money. And on average, if we averaged all of those wins and losses and sideways action, there's about a 7 to 8% per year growth in the stock market. What they don't tell you is that mutual funds get eaten by fees. So we don't see the 8%. We might see 5% of the 8% because of all the various fees. Now, I don't have a chance to go into all the fees that are there. Lots of good books, about how mutual funds work and how they do eat up your finances over time. But they really don't work. I mean, 8% is not a great rate of return, right? 5% is certainly less. But there's some other things about the stock market that you have to realize, right? For example, in the last 100 years, on 4 separate occasions, the stock market for about a 20 to 22-year period has gone sideways. You can see here it went sideways for 22 years, went up. Here it went sideways for 22 years, went up. It's sideways for 22 years. And here we're about 12 years into a 22-year cycle. So what does that mean? Well, it means like if you're 55 and you got 300 grand in the stock market, yes, it's going to go up for a couple of years, and then it's going to drop, and you're going to have 300 grand when you retire at age 65. Not the best choice. What's even scarier about that is, in most cases, financial advisors who know things about the stock market, or mutual fund managers who know things about the stock market, knew that the stock market was going to crash, and they didn't tell you. A good example is both my parents got hit rather badly, in the 2007, 2008 period of time, where the stock market crashed in January and then crashed again in October of 2008. I was telling them I need to get out of the stock market based on a very simple technical analysis that every mutual fund does, that every financial advisor worth his salt knows, and that's the 200-day, 50-day moving average. Right? The 200-day, 50-day moving average is a key technical indicator, and it's something we can take a look at. But if you go back to 2008, you can see there's a blue line and a pink line, a red line. And this is the 200-day, 50-day moving average. And basically what it does is it takes an average of the last 200 days and an average of the last 50 days and plots it as a course rather than the price of the Dow or the price of the SPX or whatever it might be. So this is the Dow, back in early 2008, and you can see that it crosses. The trend was going up, and then these two lines cross. Well, they call that the death cross in the business, and it's the death of the stock or the index or whatever crosses. And you can see that the market crashed and burned shortly after that, all the way through 2008 into 2009. The stock market lost over 60% of its value. They knew this. They knew the day this happened, and no one called you and said, hey, look at the Dow just crossed on its 200-day, 50-day moving average. It's highly likely in the next 6 months to a year the stock market's going to go down. Can you imagine a mutual fund manager telling everybody to get out of the mutual fund? He'd lose his job in a minute. So would financial advisors, because they get paid for your money being in the account, not out of the account. That's where I get kind of disgusted at the whole industry. Right? They don't have your best interests at heart. And this happened, by the way, not just on the Dow, happened on the SPX. You can see it happened in January 2008. Crash and burn happened on the Russell 2000 a little bit earlier, ended in late November, December that happened. Right? So the number one technical indicator told you it was going to crash, and it crashed. In fact, one of the things I'm really disgusted at is, in 2008, there was an award that Morningstar, which measures mutual funds in terms of results and everything, gave to the number one mutual fund manager in 2008 because he only lost 18% in his account. Everybody else did 60%, and he only lost 18%. Still disgusts me. I mean, if I lost, 18% of my business, I'm sure I'd get fired, right? Okay, so what's the message? You need to stop trusting others. You need to take control. Now, if you have a 401k, two things. If you work for the company and no longer work for the company, it's considered an orphan 401k, which means you can take that money in that 401k and roll it over to an IRA literally right now. Right? That means you can take control of it. So do a self-directed IRA, whether it's a Roth or traditional. I kind of believe Roth is better. Not trying to give you any advice. You might take a look at the difference between the two. And the difference is kind of simple. The Roth, you pay tax going in, but you don't pay tax coming out. On the traditional, you don't pay tax going in, but you pay coming out. So if you think you're going to make a lot of money in the stock market, a Roth might be a better selection because when the money comes out, you don't have to pay tax on it. You can roll your 401k over. If you can't, then you can borrow up to 50% or $50,000, and that might be a good way of starting your own brokerage account where you can start to trade and make better than that 8% or 5% a year in terms of what the mutual funds are averaging over the last 100 years. You also might learn a little bit about, a solo 401k and some of the products that are available, for small businesses, right? And you may think about trading as a business sometime in the future because, tax rates for businesses can be less than whatever. And, if you start doing a self-directed IRA, you can actually take a look at the ones that are done through some of the brokerage houses like E-Trade and Schwab and Options Express and Thinkorswim, and I use Thinkorswim as a trading platform, but that's only the stock side of the fence or the options side of the fence. You can also take a look at, 401 or sorry, self-directed IRAs that will allow you to do real estate and tax liens and things of that nature as well, because they're allowed to. And just go onto Google and look for some of those things. The third thing that you want to consider, in terms of it, is making sure you're investing in the right products, not the wrong products. And what I mean by that is, one of my mentors decades ago, his name was Charles Gibbons, said if you don't make 15% a year annually on the product or service, you should not invest in it. And I took him literally at heart. So when I'm looking at real estate, or I'm looking at the stock market, or I'm looking at options, or whatever it might be, I've got to make sure that I make that 15%, because that percentage race will compound my money faster. And just to kind of give you a quick example of that, this is an investment of $10,000 today, taking a look at it over a 36-year period at 5%, 8%, 10%, and 15% annual returns. No other money put into it. If I put in 10K today, and I get a 5% return, that's 58 grand. If I get a 8% return, that's 135. If I get a 10% return, that's 309. Which is better. But man, if I can get that 15%, literally, it's 1.5 million bucks. Now I got to put a bug in your ear. This is in 36 years, right? That's a long time. Okay, we're talking about 36 years. That's a lifetime. But what would happen if you learn some strategies, and these might be options strategies or Forex or futures, where rather than making, 10% a year, you made 10% a month, or maybe 15% a month. Then it's not 36 years, it's 36 months, right? So there is a cost to ignorance, right? And it can be literally millions. So I would suggest to you that you invest in your stock education, your real estate education, your small business education. Maybe get a mentor, to make sure that you compress time, and rather than making it 36 years, making it 36 months. Now, there's no guarantees here. You have to know what you're doing. You need to be trained. You need to know what you're doing. But the potential is definitely there. In fact, I know one strategy, that 12 years ago was making 10% a month, and on average nowadays is doing 6, 7, or 8% a month. And I'll kind of share with you that strategy in just a few minutes. So make sure you pick the right investments, not the wrong investments. You also want to make sure that you start thinking about multiple types of investments. Most people in life work hard for money. If you take a look at that left-hand side, the guy is actually digging the ground. If you look on the right-hand side, the money's digging the ground for the guy, and he's much richer. And what I mean by that is let your money work. Or another way of saying that is letting your assets work, right? So we want to get multiple sources of income, right? We definitely want to have, as a friend of mine said decades ago, Robert Allen, right? We want to have multiple sources of income. We want a job, yeah, because that can give us initial cash to do things. But very quickly, we want to build that small business. We want to quickly get the stock market working for us, or our money working for us. We want to get real estate working for us. And that really comes down to a concept or an idea that I believe in wholeheartedly. And that is, you've got to put not you to work, but your assets to work. Now, most people, start off with what I call man at work. You find a job, and then you realize, well, geez, I'm not making enough money, so I'm going to work harder. Or what I'm going to do is I'm going to work as hard as I can. I remember I was making 60 grand a year one year, worked my butt off, did really well, brought in something like $46 million into the company, Fortune 500 company, and I got a $6,000 raise. I worked my butt off 50, 60 hours a week, to get an extra 6 grand, and there's got to be a better way than just working hard. So what most people start to think about is, well, I know what to do. I'll start a small business. So what they do is they become self-employed. They put that S on their chest. Yes, they make some more money, but they have a little more risk. What I mean by a little more risk, when I first became a business person, and I literally walked away from the 8.5 years of a Fortune 500 company because I had some money and I had some skill sets and I figured I could do it myself. I had 6 weeks of joy, meaning money was coming in, and 6 weeks of hell where the money was going out, and I had expenses, and it was a friggin' roller coaster ride. Now, it was cool because I was in charge of my own time. I'd work some days and not some days, so that was cool. I got a little bit of a tax break by being self-employed. Not a great tax break, but a little bit of a tax break. But really, what you want to have is not be self-employed, but you want the business to make money. And this is what I call assets at work. We want to move from the left side of having to work ourselves or being self-employed to having our business work for us. And there's kind of different kinds of assets that we can put to work. One asset is certainly real estate. Certainly with real estate, and there's different strategies out there with respect to that. I don't really believe in the buy and hold strategy for real estate in terms of appreciation. It can be a bonus, but I like cash flow real estate. So we want to buy real estate. We want to buy real estate with as little down payment as possible. In fact, that leads to the discussion we'll have a little bit later on about leverage. You can also buy real estate with no money or limited money. You can do creative financing. You can do a lease with option to buy. You can do a vendor take back. There's all kinds of different ways you can structure a deal to get into the real estate game. So we may want to spend some time learning about real estate strategies. We want our business to work. Now, when I say business, real estate is a business, so we can do real estate, but I'm talking about, buying and selling and trading and, things of that nature. Now, the easiest ones to get started nowadays were obviously the internet. If you're going to get into the internet business, there's kind of 3 areas you want to focus on. Certainly, you can make money on eBay. My daughter loves making money on eBay and has during college and after college. You want to work on an Amazon store, right? So you've got a store on Amazon and selling products through Amazon, and you want to have your own website, your own piece to sell it. I do a number of different products that I sell, and they're sold on various websites throughout the internet, which are standalone, which bring in some cash for me. So we do want to have business, and internet's the easiest way to go. And it doesn't really matter to me what business you start. It might be an MLM, it might be a restaurant, it might be a wagon, selling water. Who knows? But whatever it is, get that business started. Start your business. Start whatever it is. Get that second source of income or third source of income. Get your investments to start working, specifically the stock market, and not so much the stock market as in stocks, but options strategies with respect to that. I'll talk about option strategies and something called leverage in a little bit. You also need to start thinking about maybe intellectual property. One of the best pieces of advice I got was from Ken Blanchard. And Ken did a presentation for me, and I got to go golfing with him the day before. And on the way home, he was telling me various different strategies about his marriage and love life and business. And one of the things he said was, Jim, you got to make money while you sleep. You got to write a book, you got to write a product, you got to build something that will sell automatically when you don't have to be there. So take that to heart. Maybe it's a book, maybe it's something you love that you can share with other people and put it online or on the internet or in Amazon or whatever it might be. I also, when we're talking about putting assets to work, I want you to also start thinking about what some of your limiting beliefs are, in terms of wealth and finance and things of that nature. And we all have them. The one that freaks me out the most, and there's several, right? People say they don't have time. People say they don't have money. That doesn't. People are afraid. I get that, right? But they can all be worked out. The one that freaks me out the most is when people are afraid of debt. Okay, and there's a big element in our culture now that says debt is a bad thing. It is a bad thing if you're putting yourself into consumer debt. You're doing vacations that you can't afford, clothes that you can't afford to impress somebody that doesn't even like you anyway, right? So debt is best used to buy cash flowing assets. So I'm going to challenge you with respect to that. And I'm going to kind of give you an example of this, from my own life and having a conversation with one of my sons. So one of my sons had $6,000, and he came to me when he was 16 years old and said, Dad, I got $6 grand saved up. It's in the bank. I want to buy a car. Now, with 6 grand, what kind of car is he going to buy? It's not going to be a nice, red, shiny, brand new car. It's going to be a piece of crap, right? Now, I know the piece of crap is going to cost them 1,000 or 1,500 bucks a year to maintain and to fix, whether it's the tires, the transmission, or something's going to go wrong with it. I also know that he's got to pay insurance, or somebody's got to pay insurance for it, so it's going to become an expense. This is not an asset. This is a liability, right? So what I mean by that in terms of a liability is he's not going to make money with that 6 grand. So now he's got a financial drain on himself. So what I said to him, and a bit of a challenge, a bit of an incentive and a reward, and I wanted to convince him to start learning about building a cash flowing asset. Is I said, okay, Mike, rather than doing that, what I want you to do is I want you to take that 6 grand, put it into a strategy called credit spreads, right? Don't try this without really knowing what it is. And back then we were earning between 8, 9, and 10, even 12%. So I'm going to use 10% as a number a month. So if I've got 6 grand in an investment that makes 10% a month, I'm making 600 bucks. So if I'm making 600 bucks a month, that 600 bucks a month can literally double my money in a year, and if I do that every year, very quickly I can progress from 6 grand to 12 grand to 24 grand to 48, if that makes sense to you, if I don't eat any of it, right? Or now I've got 600 bucks coming in per month. If I have fairly good credit, I can go out and lease a car for the 600, and the asset, the investment of the 6,000 and that 600 bucks a month coming in pays for, the new car that I'm going to get. And in this case, the way I bribed him was I actually gave him one of my older cars. I gave him my Navigator, so that he would have a car to drive around. But he learned how to trade. Literally traded, when he started 16, he paper traded for a while. Then he started trading in my account. At 18 in his own account, when he got out of college, didn't come home, lived in his own apartment, had his own car that he negotiated and did financing for because he could show that he was making money, had income coming in, so it was a great lesson for him to learn, and should be a great lesson for you to learn. You take money to buy assets, the assets pay for lifestyle. You need a new car, you buy a cash flowing asset, and the cash flowing asset pays for the new car, right? You need a new vacation or a trip, you buy an asset, you don't buy the vacation. When you buy the asset, it pays for the trip, right? And that can make you a great piece with respect to it. Now, if you're thinking about learning something about spreads or things of those nature, here's a couple of websites you might go to: creditspreads.com, finseminars.com. And these are just places that you can learn about spreads in particular, or learn a little bit more about real estate, whatever it might be. But there are things that we want to learn about in terms of cash flowing assets. We want to learn how to trade. We want to learn how to do real estate. We want to learn about small business. We also want to learn about leveraging our assets. And it's okay to have debt, for cash flow. Now, one of the things you don't realize yet is if you have a business and it's cash flowing, you can actually borrow money from banks. And that money you borrow from banks, at 6%, you can put into an asset that's going to maybe earn you 20% a year, 50% a year, even 100% a year. And you want to also make sure you protect your assets. So don't forget to learn about asset protection and taxes as well. We definitely want to have a business. We want to have a business for the purpose of making income. It is for income generation. In fact, the IRS code says you can't have a business for tax deductions. It says you have to have business for producing income. So our goal with our business is to make money, no question. But also at the same time, when we have business, we can get some deductions that we don't get if we're in our own personal business. My computer is not my computer. My computer is my business computer. So that 2 grand for the latest, greatest Apple laptop, I didn't pay. The company bought it within the asset. Now I use it for business, right? So you can buy certain assets or certain lifestyle. If I'm going on a vacation, I don't go on vacations. I go on business trips. I have invested in real estate, don't as much now as I used to in the past. But when I go to some other location, I'm going to make sure I'm looking at real estate so that I can write off those expenses to the business. Now, you want to get good financial advice, good tax advice with respect to this, so get some good tax advices. But you can make 50%, 100% of your lifestyle tax deductible, right? So, and there's different strategies with respect to that. In fact, the interesting statistic that was put up by the IRS over a decade ago, 89% of the people in America that make $50,000 a year or more own a small business. So we want to get that small business up and running. Now, if you want to learn a little bit more about small business and some of the deductions you can take, what I would do is I would go to the irs.gov, right? And when you go to the irs.gov, you want to pull publication 334. Right, publication 334, and that shows you how to write off certain expenses. Whether that's business trips or cars or meals and entertainment. It used to be 100%, 75%. Now it's 50%, and they're actually talking about changing this year. Where entertainment is no longer 50%, but meals are 50%, and I'm in 2018 right now. So we do want to take a look at some of those rules and regs, and the IRS has a nice publication called Publication 334. So go to irs.gov and pull the publication on small business and start reading through some of the things that you can write off. Paying too much for life insurance and for life expenses. Always good to belong, to Sam's Club, where you can get a discount, in terms of your groceries and your regular life expenses, but also some of the other things. So for example, as I was going through my own education, I had a great mentor. His name was Charles Givens. Givens wrote a couple of books. One was called Wealth Without Risk. The other one was More Wealth Without Risk. The other one was Financial Self-Defense. And he actually had a personal development book called Super Self, Super Mind. But Chuck talks about different ways to cut different things. So for example, life insurance. There's term and life insurance, and there's whole life or universal life insurance. Term insurance is pure insurance. It's if you die, you get X amount of money, and there's no investment vehicle with it. Universal and whole life has an investment side. Now, this is not absolute, but it's better for you to buy term and then take the money and invest in other things. A.L. Williams made a whole business of this when they were out there, teaching people to invest in term and put the other investments into other types of investment vehicles. Because if you put it into the whole life or universal policies, generally speaking, and not in all cases, because some of them are tied to variable universal life, but you're making 4%, 6%, 8% per year, which is pretty much the same as a mutual fund, right? So you can do much better if you control it yourself. Car insurance is kind of interesting. I kind of make sure that I have high deductibles on car insurance. It makes my insurance less. And seriously, if I have a $300 ding or a $500 ding, I'm probably going to use a credit card and fix it, and not report it to my insurance company, so I don't have a premium increase. But Chuck in his book goes over some great strategies, and obviously you want to talk to an insurance professional with respect to it. But start cutting some of your life expenses, whether that's the groceries or the things that you buy, getting into a club, whether that's a furniture club if you're into buying and selling real estate or whatever it might be. One of the things you want to really focus on is something called leverage. And what I mean by leverage is understanding that certain investment strategies or vehicles have different leverage. Now, the one that's most common is, when you buy a house. When you buy a house, you put 20% down and you use a mortgage to buy the balance over time. And you got a $20,000. Let's say you got a $100,000 house. You got 20 grand down. You got a $100,000 house. The appreciation or the growth doesn't happen on your 20 grand. It actually happens on the 100 grand the house is worth. So if you're sitting there in a 10% area, right? Not saying that 10% is common. I'm just saying if you are in a 10% area, your house goes up by 10 grand every year. So on the 20,000 that you got invested, you really made 50% on your money, right? 10% on the house, but 50% on your money. So leverage is something we like. The better the leverage, the better we are. Now, real estate, a 1-to-5 leverage or a 5-to-1 leverage is pretty common. But if you learn how to do creative financing, like if I learn how to put 10% down and leverage 90%, then I got a 1-to-10 leverage I've got 10 grand out and 10 grand up. I'm making 100% on my money every year, while I'm living in the house, right? So we want to learn more about leverage. In fact, you want to learn about creative financing. And I know that there's 21 different creative financing strategies that are out there. I learned from a guy named Jim, and he certainly is a great instructor when it comes to teaching people about creative financing. So we do want to learn about a lease option or seller financing, or a second mortgage, or a way to leverage it so that we can put as little as possible out. And guys, it's possible. I've done it. I know other people have done it, like hundreds and literally thousands of people that have done it. You just gotta be in the right place at the right time, and more importantly, you got to be looking for it and know how to take advantage of the opportunity when it comes. So, just talking about leverage, real fast. Common for having a 20% down on a big asset in real estate. That's a 5-to-1 leverage. That's great leverage. But we do want to learn about creative financing, whether that's a lease with option to buy or a vendor take back, seller financing, things of that nature. And that's not just in the residential side. Quite often when you think about mobile home parks, or you think about commercial real estate, quite often there is seller financing involved in commercial real estate. So we definitely want to take it not just on the little houses, the 3-2s and the 2-2s, but think about some of the bigger deals that we potentially could do in terms of leverage and creative financing. Trading, I really believe in trading. Notice I said trading and not investing. You want to become a good trader. Simple leverage. When you set up your trading account online, you can set up a margin account, which means if I put 100 grand in there, I can actually buy $200,000 worth of stock. That's leverage. That gives me 2-to-1 leverage. So a margin account is an ability for us to buy more than we normally would be able to, by putting some cash in there and signing that margin agreement. You want to learn more about online trading and those kinds of things. If you go to options trading, options trading, 8-to-1 to 10-to-1 leverage. And what I mean by that is, I'll just give you a Coca-Cola example. Let's say Coke's trading at $40 a share, right? If I want to buy 100 shares of Coca-Cola, that's $4,000, right, out of pocket to buy the 100 shares. Everybody with me? Right? But I can buy the option on Coca-Cola for 60 or 90 days for $4 a share, which is $400. So there's 10-to-1 leverage there. So I can buy the same amount of shares, 100 shares, which is one contract in options trading, right? And you want to learn what that really means. Or, I can buy more shares, right? So it gives me greater leverage, greater potential. Futures, even better, 25-to-1. Forex, I know the slide here says 45, but it's actually 50-to-1. Intellectual property. What's the return if I write a book for 16 hours, get it built, put it online, and it's selling online. It's the amount of time that I spent writing the book. So we definitely want to learn a little bit more about leverage with respect to that. Owning a home. Owning a home is a form of leverage, because you probably are going to own that house, and this is actually a pro and a con. Most people, buy their house, and at the end of their life, when they're 65, it is their greatest asset because it appreciated every year for the 20, 30, 40 years they were there. They paid off the mortgage over time, and now it's gone up in value. And the shame is that most people have to sell that asset, and move into a condo or a smaller house to live and exist, because that's the money they need because they didn't have money in their retirement account, right? And I got the question just recently from somebody who was young and starting out. Do you buy your own house or do you buy a rental property? It's an interesting question. And the reason it's an interesting question is, if you buy your own house, you don't have an asset really, you have a liability because you're making that payment every month. Yes, long term, we hope it appreciates, but you have no cash flow today. You may over time have an asset because it grows and you sell it, and there's difference between what you've paid and what the market is nowadays. Or do you take the money that you've got and buy a rental property, or a lease with option to buy, and do it that way. And I kind of have mixed opinions with respect to it, because if you own your own house, you got money going into the house, right? You get to write off your interest, which in the first 10 years is most of that payment. So it actually reduces your taxes. So there's a tax benefit for doing that. But it is a liability until you kind of sell it. And then, if you do a rental property, you might have $200, $300, $500 positive cash flow coming in, right? So I kind of have a mixed opinion, and I don't have an answer for you. It's just an interesting conversation. I probably would go with the own my own house and do the rental property, but I know some folks that do the rental property first, and with the cash flow that they earn, buy their own house. If they buy their own house, it's a longer term investment, and I think the key there is the tax benefits or savings that you get. If you're paying $1,500 a month, and 1,400 of that is interest, and you're taking a huge deduction, with respect to your own 1040 tax return, that can be a pretty significant savings. So I'm going to look at the cash flow versus the tax savings with respect to it, so and run side by side numbers and figure it out. So we talked about that. Also start thinking, if you're going to rent properties out or lease option, you want to think about multiple properties. It is always better to do a duplex, a triplex, a quad, an apartment complex than it is an individual house. It's always better to do, a mobile home park, or multiple sources in an assisted living facility, 55 and older community, than it is to buy your own house. So consider those bigger deals versus the smaller deals with respect to it. Owning your own house, the last one I kind of leave you with is, lots of people will spend 10, 15, 20 years building their assets, and then some life experience will happen. And, I call building a fortune, fortunate. And then what happens is a misfortune, right? And a misfortune is an illness. A misfortune is a death. A misfortune is you're driving down the highway and you have an accident. You can no longer work, and you lose that job income. You do pretty well in life and you get sued. You screwed up on your small business taxes and the IRS freezes your assets, and you're stuck, and you got to start over again, right? Those are the misfortunes that happen. So one of the things you want to do is to kind of make yourself bulletproof. So I can't go into that in great detail. I mean, I literally could spend 2 hours going over, asset protection and strategies and that nature. But I want you to start thinking about, geez, if I spent 10 or 15 years building it, how do I protect it? So you want to make sure you protect your individual home. You want to protect your business. And if there's a lawsuit, you want to become bulletproof. So you do want to spend time learning about asset protection and those kinds of things. There's some very successful people who did incredibly well in their lifetime, like Boeing, Marilyn Monroe, Elvis Presley, Rockefeller, Morgan. They did well, but they still lost 47, 73% of their estates, because they didn't have the right asset protection plans. So we definitely want to learn about asset protection. We might think about a land trust for property. I know you don't know what that is, but you want to learn what it is. You might think about, LLCs for some of your personal assets. And you certainly want to think about family limited partnerships or series LLCs down the road. So you kind of want to learn that. Well, guys, we talked about 11 different strategies that help you get started. And I'm going to kind of finish with a 12th strategy, kind of a bonus. The mass majority of people follow the 40-40 plan. What I mean by that is they're told they have to work 40 hours a week for 40 years, and they don't realize that when it's all over, they live on a 40% of their lifetime. They're told to get a job, get married, have kids, and then they pass on that strategy on to the next generation. I'm going to suggest to you that you want to take a road less traveled. What you want to do is become part of the group that moves on what I call the 777 plan. 7 figures, whether that's 7 million, a million, whatever it is for you, using 7 strategies over the next 7 years. And then you have choices that you can make. Choices to continue working, choices to retire, choices to enjoy life. I really believe that your life can be a masterpiece, but you have to choose to make it a masterpiece. I hope you enjoyed those 11 and the little 12th bonus. To do the 12th bonus, get yourself educated. Get educated on real estate, the stock market, investing. Get educated on trading. Get educated on asset protection and small business. And I'm going to suggest to you that you get a mentor. Get somebody that can walk you down the path and show you the path so that you can become much more successful in life. Travel and have a great life, enjoy it. I certainly have. I know in my life things have become a masterpiece. I've traveled the world. I've enjoyed life immensely. I've got toys. I've had toys. I've enjoyed all of that because I decided to make the decision to invest in myself and take the road less traveled. Here's Jim Francis saying so long for now. I'll see you next time.